Good morning, folks. Welcome back to Macro Crazy. Bit of a surprise this morning. GDP number came out 3.2%, which was hotter than expected at 2.9. So markets are moving to the downside. And along with that, there's some comments from David Tepper. If you don't know, he's like a hedge fund manager, investor, whatever you want to call him. And he was talking to CNBC, basically saying that he's not going to fight the Fed. He's going to be short stocks. And he also added that he's going to be short bonds as well. What he's saying, isn't illogical, especially the stocks, which I've been pounding the table on. You got to be short stocks, short dollar. I've been kind of on the long bonds, but he's a smart guy. I wouldn't want to fight him. So maybe further analysis is due here. You can make your own, do your own due diligence and decide. Basically, he's saying that rates are going to be higher and will be around at that level for longer than people expect, and the market hasn't priced it in. And there's no point in trying to fight central bankers around the world because inflation, as the bankers know, can be very stubborn to leave once it gets a seat at the table. Mr. Tepper also points out the hypocrisy of traders now who are literally trying to fight the Fed by bidding up stocks and bidding up bonds, when for years, like a decade or more, while the Fed was cutting rates, everybody was harping on don't fight the Fed, don't fight the Fed. So he's saying it's ironic. I don't disagree. And if you don't know who this guy is, in 2010, he said that quantitative easing by central banks would pump stocks for years, and they did. And now he's flipped and saying that basically you got to be short bonds and stocks. So it's definitely something to be aware of and consider as you make your investing decisions. Good luck with that, and you'll see more posts from me over the weekend.